All right, today we're taking a look at Connexion Mobility's latest quarterly report, and honestly, it's a bit of a puzzle. We're going to explore how a company can be hitting record revenues while its profits are, well, plummeting. So let's get right into it.
And just before we really jump in, a quick but really important note for you. This whole explainer is just for informational purposes. We're breaking down the facts from the source material, so this is not in any way, shape, or form investment advice.
Okay, so first things first, what exactly is Connexion Mobility? In the simplest terms, just think of them as the digital brain that manages all those dealership loaner cars and courtesy vehicles, the ones you might use when your own car is in the shop.
Which, of course, brings us to the big question. How is this company, the one that's kind of quietly powering all these transportation services behind the scenes, actually doing? Well, the answer, it's interesting.
So let's start with the top line number, which, you have to admit, looks fantastic. The company just hit a record third-quarter revenue of $3 million. That's a really solid 5% increase, and it signals some pretty strong growth.
But here's where the story takes a turn. While that revenue is hitting record highs, their net profit before tax actually fell. And not just by a little, by a steep 31%. So what is going on here? How can revenue be going up while profit goes down so sharply?
Well, the answer, according to the company's update, is actually pretty straightforward. They're saying the drop is due to a spike in one-time, non-recurring administrative and seasonal expenses. So it seems like more of a cost issue, not some kind of core business problem.
So, with that little mystery solved, let's go back to that record revenue. It's time to really unpack the company's growth engine and see what's actually driving these incredible sales.
So, a huge driver of this growth is this massive operational win. Connexion Mobility was actually chosen as the sole software supplier for General Motors Canada's entire Enhanced Exposure program. That means their OnTrack platform is now powering test drives across the entire country. Landing a deal like this, it's like being handed the exclusive keys to a massive national fleet. It's a game changer. Okay, so on one hand, we have a growing software business landing major new clients. But the second part of this story is just as fascinating, and it's all about their pretty unconventional financial strategy and what they're doing with all their money. First off, their financial position is incredibly strong. The company is sitting on a very comfortable $5.9 million in net cash, and get this, they have zero debt. That gives them a tremendous amount of flexibility and power. So what are they doing with all that cash? Well, take a look at this. Nearly a third, 31% of their pre-tax profit doesn't even come from selling software. It's actually coming from earnings on their passive investments, things like interest on their cash reserves. For a software-as-a-service company, that is incredibly rare. And that's not the only thing they're doing with their cash. They are also aggressively buying back their own stock. In just this third quarter alone, the company repurchased a staggering 98 million of its own shares. All right, so let's pull back for a second and bring these two really distinct stories together. You've got the operational growth on one side, and then this very active, very different financial strategy on the other.
So here it is, the full picture. On one hand, you have a classic SaaS growth story, right? They're expanding their footprint in North America. They're landing these huge deals like the one with GM Canada. But on the other hand, you have this really aggressive financial strategy where they're using their strong debt-free balance sheet to buy back shares and generate a ton of income from passive investments. And that really brings us to the central question of this whole update. It is a unique, two-pronged approach. So what do you think about a software company that's trying to balance its core auto tech growth with such an active financial strategy of buying back its own stock?
It's a really fascinating case study in corporate strategy for sure. We would absolutely love to hear your take on this whole dual approach. Go ahead and let us know in the comments below. Thanks for tuning in.